Welcome to Markets Now. I'm Michelle Rook with Brad Kooima with Kooima Kooima Varilek, and we are seeing some higher grain trade this morning. Cattle have been on both sides of steady right now. We're back to the plus side. Hogs have been setting back here, and Brad, cattle market, we get these little pops, but we can't seem to hold them. I guess my bigger question for you is markets, fundamentally the cattle markets, do they really justify the slide that we have had or the sell-off?
Well, thanks for having me on, Michelle. And in short, I don't feel like this is a fundamentally inspired market.
No.
We're $30 off the highs on February cattle, 30. And yes, we came from a high level, and I think all of us thought, coming off of record levels, have a $10, $12 break. Probably wouldn't be a surprise at all. But to say that the fundamentals today are radically different than they were a couple of weeks ago or even a couple of months ago, the one thing that is different is our average weights are higher.
Right.
And, partly because of that, we've lost something that is critical to your ability to have any kind of power in the marketplace, and that word is leverage. We had it for a long time because we'd done such a great job of being current. We had a difficult winter, a tough summer weather-wise. We were making a lot of money. People were anxious to sell cattle. You had a futures market at a discount to the cash, which further incentivized to stay current. And then in the last few weeks now, that seems to have changed. So, but because it's only a few weeks, it's not like, it doesn't feel like 2015 to me, although there's a lot of price similarities, but we really got backlogged that year. I mean, so I don't believe we've got that kind of big slug of cattle that we have to work through, but we all get it. The break evens are high, the feed is much cheaper, and the risk here is that we're going to feed into that deal. So that's a fundamental problem.
So when you look at the charts then, Brad, we made new contract lows in some of these feeder contracts yesterday, new lows for the move-in live cattle. Where do we stop here? What did the charts tell you?
Well, I feel maybe a little like I'm grasping, Michelle, but that's what you do when you get into these markets that really don't have a precedent. The market's gone down more than it went down when we had mad cow disease. The market's gone down further than when we had September 11th. We're approaching COVID level stuff. But okay, looking at the market technically, a couple of things I thought yesterday was making me think that maybe the planets were lining up for a bottom. One being drawing the uptrend lines off of the weekly and the monthly charts, with that major low being what we all call the COVID low made in early 2020. Yesterday's lows were within a few pennies of dead on, of holding on that major uptrend line. So that's encouraging. I thought yesterday's action was classic cattle, where we opened $2 lower, gap lower opening. That was the third gap lower opening for most of the month. Often that's breakaway, midpoint, exhaustion gap, on these big moves like that, you'll see that. And then when the market came roaring back to go higher for the day, I thought, there you got it, finally. We tested the major uptrend lines, we had our 3 gaps down, blah, blah, blah. And then to go home with your tail tucked firmly between my legs yesterday when the market failed again, clearly disappointing. Now, hope springs eternal. Let's see, once we're 90 higher, if we can get our legs underneath us here today. We're certainly trading discounted to cash, even though cash seems to be coming down as quickly as the futures almost,
Well, and the funds have exited most of that long position now. That should take some pressure off here, shouldn't it?
For sure. In fact, it's a good question, because overall open interest, I looked at that this morning too. Overall open interest, the only year that is lower this time of year, ironically, is 2015. So we've we've liquidated this market down to a very, very unusually low level in terms of open interest as well.
Yeah. And Scott and I talked about the LRP program being maybe a little bit of a factor here. How much of it was the LRP program? You said it was maybe the last part of the sell-off.
Yeah, neither Scott nor I or anyone, I don't think, it thinks that the LRP program is the reason the market broke. But I certainly believe that it was part of the reason that this last leg down, or the acceleration, and particularly and especially in the feeder cattle contract here, was influenced by that. I could talk an hour about this, but used properly, the LRP is a fine risk management tool. But there are some that exploited, we believe, the use of it, and that, I think, created that last draft of forced selling with that big move that came in the feeder cattle. So it's not the reason for the big break, but it certainly contributed to the last part of this leg down, in my opinion.
Some have suggested, not you guys, but some other market watchers have said that this is the demand problem, the confidence that the consumers are going to stay buying beef. Is that really it?
12% went overseas last week. That's a big number. Choice select spreads at 32. If we had such a demand problem, I think they wouldn't be paying up to buy choice. Stock
I just
market,
had to
maybe.
poke the bear a little bit. I just wondered. I knew what your answer was going to be.
Yeah.
So.
Well, if you and I could figure out demand,
I know.
neither one of us needs this radio program, right? I mean, it's not. I don't think it's a demand thing. It's the leverage thing.
Gotcha.
I mean, we killed 125,000 yesterday. The Packers making all kinds of money with the 294 box. I mean, that part, the chain part of the thing seems like it's fine to me. Let's get ourselves good and current again. Let's get back to negotiating some cash cattle, and let's see if we can't get our legs back underneath us.
Yeah. And part of this sell-off too, I think, has been those unwinding of those cattle hog spreads. And it looks like we're doing that again here today, huh?
I think you're the only person that asked me, and you're spot on. There's no doubt in my mind that there's a couple of algorithms that trade that cattle hog spread.
Yeah.
I mean, here we sit with hogs 180 lower and cattle 80 higher. I mean, so.
Yeah, it's almost uncanny here. Hog market, though, just put in new contract lows last week, and we've bounced off that level. But, other than technicals, what is the market trading right now?
Yeah, I'm tempted to give you that smart aleck comment of the only good news is that there isn't any.
Yeah.
That's almost how it feels. Seasonally, you'll make a low in December. Maybe we're getting closer. Average weights are almost 4 pounds over a year ago. So far, exports are all right, but everybody seems to be worried that race might have short legs. We'll see. You've got an awful lot of pork you got to work through, and you got to have perfect demand, and none of us feel very confident that we're going to have that.
Yeah, and China's still liquidating their herd, so that doesn't help. Grain market, well, we're led higher here. It looks like this morning by another announcement of China SRW wheat. I know you love talking about the wheat market, but we have to talk about it because it's part of the reason that the corn market has been able to rebound here off contract lows too, isn't it?
You're 100% right. Yeah, and you and I kid about wheat, but it's kind of an inside joke. Don't raise a lot of it in Iowa, but it's important to the market from the standpoint that it has kept the lid on corn prices here for a long time. You've got a world that supply situation that they're full of it, right? I mean, it's a product that's raised year round around the world. Okay, so there's always some of it for sale, and we've been struggling with that competitive part that has held back the corn. Now, I probably said it. You probably heard it from others that if China's buying, that's all I need to know. Now, I'm being a little bit facetious, but the fact that you finally, had China step up and do some business in the wheat market, it was very clear yesterday that it made a difference to the corn. I mean, you had the beans breaking out to the downside at the same time that the corn was having a nice solid up day. So I think you're getting some of that follow through again today. Now, on the corn thing, the basis levels in my part of the woods here, and then a little bit east of me where it's more ethanol influenced, the prices, basis has gotten much stronger. So that's that's a little friendly sign, of course. You get out to the Dakotas, basis levels are real poor there. But as you get more into the traditional, the heart of the corn belt, it looks like basis is firming up, and maybe we're trying to get our legs underneath us. We got a little ways to go. I think you need to get March corn above 497. And that doesn't look very far away, but we can't seem to break out of this sideways pattern as we've talked about over and over for a long time.
Yeah, I was going to say that's pretty stiff resistance. We'll see if we got enough gas in the tank to get over it. All right, thanks for joining us. Brad Kooima with Kooima Kooima Varilek. That's Markets Now.